Okay, thanks. And again, I want to thank the three authors, or actually there's 5 authors of 3 papers for some really excellent papers, and I think they're real insightful. So it's my job now to try to take the 3 papers here and connect them together to help us kind of understand them and how they fit into the kind of the overall flow of research, but also what are some of the policy implications. And so that's one of the areas I'll challenge these guys on, is to put that into the papers and to show that. So again, I'm Tom Seams. I'm at the CSBS. I'm their first economist. So on the one hand, I'm the best economist that CSBS has ever had, and on the other hand, well, we won't talk about that. So what research question is being addressed here? They really do all address this question about how do local shocks impact banks in local markets and elsewhere, in adjacent counties or whatever. And so all of these papers kind of use a similar approach of trying to say, okay, these banks are affected directly, and then let's find some that were not directly affected, and let's compare the differences, do a differences in differences approach. And so, again, the 3 shocks are the lottery winners that Carlos talked about, the natural disasters that Rajesh had in his paper, and then finally the oil price shock, which is a little more drawn out, not as sudden maybe as a shock as the other 2 papers. So this is kind of my summary then of when I read the papers, and I said, well, what are some kind of the key findings and insights that I got out of each paper? And so from Carlos's paper, the first one is that jackpot shocks significantly increase deposits and lending. So this is kind of a what question, and it's interesting. And again, I'm going to kind of challenge all the authors. It's great to have answers to some of these what questions, but what we really want is to have answers to questions like the why questions. Why is it this case? Why does that happen? Another important insight here, multi-state banks reallocate funds across different credit markets, but these allocations, he found, are 5 times greater within the state. Again, interesting result. This is one I would consider one of these very interesting results here. Section 109, what's the deal with it? How is it impacted here? It seems to have negatively affected the fund mobility and the loan performance. And then finally, also, Carlos had pointed out that the state boundaries matter for this capital mobility, in part because of the regulatory distortions that are created by Section 109. So that's kind of my key summary on that paper. My key summary on what I'll call the CVZ paper here, the Chamberlain-Rajesh Zeng paper. Natural disaster shocks on loan loss provisioning is negligible, but larger banks adjust their loan loss provisions quicker than smaller banks do. Again, a good what answer, a good interesting result from the paper. Another good, interesting result, smaller banks with more generous loan loss provisions and their higher Tier 1 capital have greater lending growth in these post-disaster periods. Interesting. And then very interesting, I think, is this result that there doesn't seem to be any evidence that banks with the more forward-looking loan loss provisions are better prepared to respond to some of the loan demand in these post-disaster periods. All right, and then finally, our third paper, some of the key findings and insights here from Teng Wang's paper. Negative oil price shocks lead to greater loan defaults and lower deposit inflows in these concentrated regions for oil and gas. Okay, interesting result. Affected banks tend to sell their most liquid securities to replenish liquidity. That's very interesting there. And then very interesting as well is I think that these affected banks contract their lending to the small businesses and the mortgage borrowers, and this effect is more pronounced at the smaller banks. So to just try to pull all this together and kind of see how it fits into the research and policy implications and so forth, This is how I see that these papers are connected. One is they're all connected by these shocks. And there's some exogenous shock out there that occurs. And of course, some banks are directly impacted, some are indirectly impacted, and then some banks are not impacted at all. We're trying to sort them out. What I think would be super interesting is to do maybe as much as possible on differentiating here by bank size. The community bankers in here have known this for a long time, that the large banks are kind of hard data organized. They do information processing really well. The small banks is what they do relationship lending. And you all have been talking about that for years. I don't think the research has touched on this as much until more recently. And now there's a nice strand of research that's been going on for 10 or 15 years that really looks at this small bank, large bank differentiation here. And so as much as we can do on this question in this area, I think will also contribute to the whole bank competition and performance literature. Ellen had brought this up a couple of years ago, that there's a kind of a nice long history of this literature, and I think this fits within that and should be kind of called out and talked about as part of that literature. So this is the question I posed to these guys right off the bat when we had our call a couple months ago. It's like, why should anyone care? Why should economists care? Why should bankers care? Why should policymakers care? And again, I think it's important for researchers to keep these questions in mind. We can find some really interesting results, but you got what, so what, and then now what. So that so what question needs to be answered, and then we can move on to the now what question. So this is kind of what I got from why should anybody care. Again, I'm going by all three of the papers here. So Carlos basically is saying that current regulations, this Section 109, constrains capital mobility and weakens diversification from financial integration. That's a pretty big, why should we care about the results that he's found. For Rajesh and his co-authors, current loan loss provisioning practices and decisions to raise capital may not be related in time. So there's this kind of time inconsistency problem of trying to estimate what the requirements are going to need to be, or what the amounts need to be. And then finally, from Tang's paper, branch banking networks can transmit these negative economic shocks across regions, I think is an important implication of kind of understanding how that happens, why it happens, does it happen with bigger, smaller institutions. Those kinds of questions then need to be ferreted out in a little bit more detail. So, now what, right? Now what? What do we do? Some questions. Does Section 109 in Regal Neal need to be amended or improved in some way to improve the flow of capital across markets? Is the CECL model premised on a faulty assumption that loan loss that loan loss provisioning and capital raising are related in a causal manner? Third question. Should some new policy tools be created that offer temporary liquidity help to regional banks impacted by a regional downturn? Something that could be given just kind of in a short-term interim basis as we go through this shock period that we might be experiencing. All right, now it's time for me to beat up on these guys a little bit and give them some thoughts on how the papers can be improved. Now, when economists get together and they talk about things, they're pretty vicious with each other. They say that if you ask economists to get into a firing squad, they get in a circle. Okay? Now, what's interesting about this conference is we're bringing together, policymakers, regulators, bankers, and economists, But when we look at the academics that are here, what's also interesting about this conference is we're bringing together economists, finance guys, and accountants all in the same room. And those three academic areas really don't talk to each other that much. So I think that's really cool about this, because they're all related to banking, all the subjects. In fact, we have, I think, finance, accounting, and economics right here. So we have all three. All right, so this is kind of my blanket, how can these papers be improved for all three of you guys. I have some more minor comments on each one of the papers, but these kind of affect everybody. And I use the word stress, and after I read this, I said, well, that was probably a bad word. It should be emphasize the importance of banks, particularly community banks, to the local economies and communities. We know it's important. I think what you're finding can show some of that importance, but something that kind of talks about that whole importance of the community banks to these local economies and communities, and can reference research that has been done, particularly good research over the last 15 years by folks in this room. Emphasize bank size differences where they exist and where you possibly can. It kind of relates to that first one about the importance of community banks. But how's that different from these large regionals or big multinational, international banks? Address regulatory and policy issues and the potential implications. Again, I think this is really important. It gets to that now what question. We can answer these what's, so what, now what? What are the policy implications from this research? And some of you might have some good thoughts on that and questions to address these guys here in a minute. And then finally, I think you can place this in the whole context of the bank competition and performance literature that is, it's been going on for 40 years, but in the more recent years, it's been getting a little more of a kind of a community bank channel and a larger bank channel, kind of separating out the implications from both of those sides. So those are my comments.